In the middle of 2007, the stock market was the place to be. Major indexes were all in a very strong uptrend from mid August until the end of October. On October 31st, the NASDAQ sculpted a picture perfect session up 1.5%, closing near the highs for the day on stronger volume. It also marked a multi year closing high. This left investors with the expectation that the market was going to continue higher. There were no signs of bearishness or weakness at this point. Then, on November 1st, everything changed. Instead of moving higher in the morning on November 1st, the session started with a gap down, and it only got worse from there. The NASDAQ closed near the lows of the day, down almost 2.3% on a pickup in volume. It turns out this was the beginning of one of the worst bear markets in US history. One of the best qualities that you can have as an investor is being open-minded to whatever happens. With stocks, it is important to remember that anything can happen. For example, you may buy a stock right as it's breaking out of a perfect stage 1 cut with handle base. The shakeout in the handle could be ideal, occurring in light volume, and then the stock rolls over and it undercuts the buy point as well as some key moving averages. This kind of red flag is what we call an expectation breaker. We had an expectation of what the stock was supposed to do. We followed all our rules and did everything we were supposed to do, but the market had other plans. This kind of thing happens, and the key is to not hold on to your expectations once they've been broken. As IBD investors may already know, the market trend is paramount in our investing practice. 3 out of every 4 stocks tends to follow the overall market trend. So if the major indexes, the NASDAQ, S&P 500, and Dow Jones, are all trending higher, then it makes sense to have a bullish take and more exposure in your portfolio. The converse is also true. When indexes are trending lower, it may be better to take a step back. We monitor the major indexes to get a feel for where the trend is heading. Oftentimes, we'll see an expectation breaker occur on the index level where perhaps it undercuts a key moving average in heavy volume or a stalling day occurs. You handle an expectation breaker in the indexes the same way you'd handle driving a car in a blizzard. You slow down. One of the clearest examples of an expectation breaker is the one that occurred on November 1st, 2007. Other famous expectation breakers that are definitely worth studying include July 17th, 1990, January 9th, 2002, July 1st, 2004, and June 6, 2008. Now, here are a few key steps to follow once you see this occur in the market. These are your stop, drop, and roll of expectation breakers. First, stop adding to your positions and don't buy anything new. Then, conduct a review of your portfolio positions. Start by selling your losing positions, then move over to your small gainers. Most of these you can also cut loose as well. If you pyramided into a certain stock, then review the recent add-on buys. Did you get carried away and run up your cost basis? Then sell off those recent follow-on buys to give yourself some more breathing room. Then it's time to analyze the expectation breaker. If it's mild, your reaction should also be mild. But if it's bad and you're still too heavy in terms of exposure but can't decide what else to sell, consider an across-the-board cut. This is very handy when you need to reduce exposure quickly, but you don't want to sell off the wrong stock. You simply sell the same percentage amount of all of your remaining positions in your portfolio. It's best to do this in small chunks like 5% or 10%. If from here you feel more selling is needed to bring your portfolio into a more appropriate exposure level, then continue with another bout of across-the-board cutting. But be sure to guard against overselling. After you reduce some risk, you'll definitely feel less panicked and more clear about what to do next. Always remember that expectation breakers can come in many shapes and sizes, and they can occur in both individual stocks and indexes. It's extremely important to heed them with the caution that they deserve so you can ensure the protection of your portfolio.